More than 25 million retirees depend exclusively on Social Security. That's about $1,300 a month to cover all their living expenses, and it's not the way you want to spend 30 years of your life. In this video, I'll give you 3 rules for retirement investing that will make your golden years a little bit brighter. Then I'll reveal 5 stocks to buy now for your retirement portfolio. We're talking retirement stocks to buy today on Let's Talk Money.
Beat debt. Make money. Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, we've talked about the retirement crisis before here on the channel. Even those with something set aside for retirement, the median is less than $150,000 by age 65. That is dangerously low, and I feel like a lot of investors are chasing the wrong stocks trying to make up for that gap. That's why in this video, I want to start with 3 rules for retirement investing, which stocks to buy for your portfolio. If you're within 10 years of retirement, or hell, just want to retire someday and not worry if your money is going to be there, please think about these 3 rules. Then I'll reveal 5 retirement stocks to buy that will give you that growth and cash flow you need. 5 stocks that I've got in my own portfolio. I'll leave a clickable index in the video description below if you want to jump around, but make sure you see these 3 rules. The first rule of retirement stocks is that you do not talk about Wait, that's not it. The first rule of retirement stocks is income. With just a little bit of planning, you can live on the dividends from your retirement stocks and not be forced to sell out of your best investments. And this means looking for those companies that have already made that commitment to shareholder cash return. Now, this doesn't have to mean exclusively stocks that pay 3 or 5% yields, so those high dividend yields. If it's a newer company still in that growth phase, I'd expect it to keep most of the cash flow back, but I still want to see a % or 2 in dividends just to make sure that management has made that commitment. So here I'm going to be screening exclusively for stocks with a positive dividend yield. Next is I'm looking for safe stocks to put here in my retirement portfolio. 5 or maybe even 10 years to retirement is not the time for catching that next hot penny stock. I know we all want those triple-digit returns, and we've got a lot of great videos here on the channel to find those. Your retirement portfolio, though, is not the place for it. Now, that doesn't mean that you have to only invest in bonds or settle for those lower returns. We're looking for established companies with stable cash flows that have those long-term trends in their favor. It doesn't have to be just those traditional safety sectors like utilities or either, but we're looking for companies with that leadership advantage. Last retirement stocks rule here before we get to those 5 stocks to buy, and here we're looking for survivability. Nation, this idea of survivability has never been more important. There have been more corporate bankruptcies in just the first 6 months of this year than all of last year, and economists expect another wave in the fall. And it hasn't been just those in-trouble retail companies either, but solid businesses like Frontier Communications and McDermott International. And this is something we've been talking about on the channel over the last few months. When you're looking at these stocks to buy, you need to be looking at that balance sheet. How much cash does the company have? How much debt does it owe? And how well are those earnings covering those interest payments? Beyond these financials, you can look for market leadership in the company's industry and how those sales have been affected. So that's 3 simple rules for retirement investing, but I want to open this up to the community also. What rules do you use when you're picking stocks for that long-term portfolio? How do you make that decision? So just scroll down and let us know in the comment section below the video. Using those 3 rules and looking at my own portfolio, I found 5 retirement stocks to buy that will get you to that financial future. First here on our list is Cisco Systems, ticker CSCO, and its 3.2% dividend. Cisco dominates in networking equipment, which is already seeing a boom on that shift to work from home environment. The company also has a strong position in cloud and enterprise services. But what I'm really excited about here is the May acquisition of ThousandEyes, a networking intelligence company. Now, this could really boost Cisco's cloud services line. Basically, it's providing data intelligence on applications and online services to companies, which is really going to be a major trend for years. Now, like most tech stocks, Cisco is trading pretty high right now at 26 times on a price-to-earnings basis, but it blew away earnings expectations by 14% last quarter. Analyst expectations range from $41 a share to as high as $67 per share over the next year, and this is one that will continue to grow for decades. Medical Properties Trust, ticker MPW, is a healthcare REIT paying a 5.6% dividend yield, and I like this one in a retirement portfolio for 2 reasons. First is because what better way to prepare for that rising cost of healthcare in retirement than to own some of these healthcare assets like hospital properties and drug stocks. Your healthcare costs are rising faster than almost any other consumer prices, so you want that kind of exposure to this sector on the ownership side. Now, the other reason why I like MPW here is because it's really focused on that hospital and the medical services properties rather than that long-term care market and the senior housing. And most of the properties it owns are in acute care and inpatient services. It's diversified across healthcare tenants and even has some international diversification. You see, the problem that you're going to find in a lot of these healthcare stocks, those REITs, is they own a lot of that senior care housing, which has been overbuilding for years and just a really tough market lately. Analyst estimates are for a share price between $19 to as high as $23 a share over the next year, so a solid potential return on top of that high dividend yield. Another favorite of mine here, drug maker AbbVie, ticker ABBV, and its 4.9% dividend yield. Here again, we get that exposure to healthcare and one of the biggest expenses for retirees. Even with Medicare, you might have to pay a third of your drug costs out of pocket, and that can be as much as 15 or 20% of your expenses. AbbVie completed its acquisition of Allergan in May, which significantly increased the product portfolio for leadership in oncology, immunology, and eye care. In fact, 2 of its oncology drugs are growing into blockbuster status. One of which, Venclexta, is growing sales by more than 100% annual rate and did $317 million in the last quarter alone. Earnings are expected to jump 16% over the next year, and despite that upside, shares are still trading for just 10.3 times earnings, well below the average multiple of 13 times for other pharma stocks on that PE ratio, so some real undiscovered value here. Analysts have the shares between $95 a share to $122 over the next year, and this is one you can hold forever. Fourth on our list, I'm adding shares of Wells Fargo, ticker WFC, and its 7.5% dividend. Earnings have absolutely cratered over the last 3 quarters on a shift to loan loss reserves and a drop in interest rates, and the shares have halved this year. But this could be one of the best long-term opportunities out there. The lower long-term rates have been a problem for banks because they're just not able to make that much money on the spread between paying those short-term for deposits than lending that money out longer-term on the mortgages. The mortgage market has been fairly strong though, so we're not looking at any kind of a financial crisis. The Fed has promised to keep short-term rates where they are for years, and the mortgage rates have a little bit more flexibility to the upside, so I think Wells has some upside to its business here. Savings at banks have surged by $2 trillion since the beginning of the year, and that's going to give Wells and some of these other banks more money to lend out. Now, a lot of you are going to be attracted to that huge dividend, and I'll admit a 7% plus dividend yield on a large money center bank, that's unheard of. But I'm not going to say that the dividend isn't in danger of being cut. So the Fed just closed out its stress test scenarios, which is basically just measuring how the banks do in different economic stresses. And it said that it wants to limit the cash that banks can pay out for those dividends and the share repurchases in order of what kind of earnings they made. So like I said, the earnings for Wells Fargo have cratered over the last 3 quarters because they're shifting so much money to those loan loss reserves. Those reserves they keep on hand just in case loan losses get worse. Now, I think Wells can stop shifting so much money towards that to increase their earnings a little bit and maintain some of that dividend, but the cash flow picture isn't as great as it seems. Now, besides that huge dividend, though, what's really attracting me to Wells Fargo here is the valuation. Shares are trading for just 0.7 times the book value of assets. That's 46% below the 1.3 multiple where it was trading at in December. So even getting back to trading at book value, that's a 40% return on top of that dividend. Analysts are all over the place with this one. Targets range from $21 a share on the low end to as high as $40 a share over the next year. To give you a little more diversification, I want to add the Vanguard Dividend Appreciation ETF, ticker VIG. The fund holds shares of 225 companies tracking the Dividend Achievers list. Now, these are companies that have increased their dividend payout for at least 10 consecutive years, so it's not quite as restrictive as the Dividend Aristocrats list and doesn't have that same turnover. The fund only pays a 1.8% dividend yield, but has outperformed the broader S&P 500 over the last 5 years, producing an 11.2% return versus 10.5% for that large cap index. Now, I like this fund because you get a little bit better sector diversification than you see in some of these other dividend funds. It's not just all stocks in the consumer staples or utilities sector, but has some really good exposure in tech and industrials as well. The fund charges a rock bottom 0.06% expense ratio, and this is one you can hold and never have to worry about. Click on the video to the right for our complete 3-video series on how to invest, including this one, knowing what stocks to buy for your portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.